What's up, guys? Stas here, and in this video, we're going to be talking about some dividends, going over dividend stocks, a REIT, and also an ETF that I'm looking to buy heading into this week in the stock market, as I do have $500 heading into this M1 Finance portfolio, and that should be ready to rock and roll and trade with by Monday. And I also want to go over what this M1 Finance portfolio looks like as of right now, very briefly break down the holdings, and honestly, guys, nothing crazy has changed since the last update video, but I do want to show you again kind of what I'm holding and just in general get some thoughts across to you guys when it comes to my investing philosophy right now. So let's just get right into it. If you guys do enjoy the video, hit that like button and consider subscribing if you want to see further content like this, and let's talk about what is going on here. So my portfolio on M1 Finance is roughly $3,000, and if you guys didn't know, this is a dividend growth portfolio. This is focused on passive income for the long term. And this is something that I started about a year ago, back in July, I believe, of 2019. And that's been the goal since day one. And that is why you see here in my top 5 holdings, these are dividend-focused companies other than really Microsoft and Disney. Those are more dividend growth focused companies. We'll talk about that in a second. But SPHD, this is a 6% dividend yielding company, or ETF rather. DGROW, the dividend yield is, let's take a look at it, right around 3%. And DGROW is a dividend growth ETF, right? Again, the portfolio is focused on dividend growth. Microsoft doesn't really pay a dividend now that's too substantial, but over the next couple of years, the 5-year annual growth rate is right around 10%, I believe. You know, this dividend is going to grow immensely. Disney, same exact thing, although as of now, they actually cut their dividend, so that's a bit different, right? They cut their semi-annual dividend for this next payout due to everything right now with the CV, so that's a bit different, but still, their dividend, once this is all over, once we get through it, it should be back and growing at a pretty nice pace as it was before the crisis. And Johnson & Johnson here is also a huge blue chip company that pays around 2.75 PE ratio of about 23, so I'm not looking to actually buy right here. Maybe if it drops a little bit more, I'll buy it, but I want to go over what I'm looking to buy right now. Again, J&J, I'm not looking to buy it right now, but there are stocks that I'm looking to buy this week, and the first one here is going to be Altria, ticker symbol MO. And if you guys want to see a further perspective on some of these stocks to see how much they've actually collapsed, take a look at these charts, right? Altria here is at about $36 as of right now, right? You guys can see the low was at about $31. So we're not too far off of the low from back in March when the market completely collapsed, right? And as we hit $40, $43 a couple weeks ago, towards the beginning of May actually, and now we're falling back down, the dividend is actually approaching 9.5%. As of right now, it's 9.27%. Payout ratio of about 80%, 79% to be exact, and a 5-year growth rate of, get this, guys, 10%. The dividend is growing like a weed here, and it's seen a growth of 50 years, the dividend, meaning it is a dividend king, Altria, right? Ticker symbol MO. So that is very incredible, and in my opinion, this dividend is very, very safe. This stock is known to be a defensive stock, meaning during tough times, right, like we're clearly in right now, these stocks do well. It's a defensive investment. And the yield here of around 9%, guys, that is just incredible. To put that into perspective, let's say you have $1,000 and you simply buy Altria here, you're going to be getting about $90 per year just in dividends, and that's just dividends, right? If the stock goes up, you can make a lot in price appreciation as well. And Altria, I think there is some price appreciation potential in the next couple of years, if we're able to get back up to the 40, 50 level. So that's kind of a win-win situation for Altria. Another stock I'm looking to buy here, which actually you guys notice it's not in my portfolio, It's Procter Gamble, ticker symbol PG. And let me be honest, this is not a stock I'm looking to buy right now. And this is important, guys. When you're investing long term, the goal is not to just find a stock and buy it right there. The goal is find a good stock, good fundamentals, good numbers, and then set a price target and wait until it hits that price target. So right now, Procter & Gamble at $113, it's not too attractive in my opinion. I want to get in under $100. If we somehow get back to $100, I'll buy into Procter & Gamble, and if not, I'm not going to buy in. That's just the simple fact about it, guys. If it doesn't hit my price target, I am not going to buy in. And as of right now, oops, I almost dropped my phone there. This company obviously provides products that are needed in no matter what economic time we're in, whether we're thriving, recession, whatever. That's very clear. Products such as Bounty, Charmin, Tide, and the list goes on. And their dividend yield as of right now is at about 2.75%. So if we get under $100, guys, imagine that dividend yield is going to go up, because as the price of a stock goes down, the dividend yield, if it pays a dividend, goes up. So we might be seeing a dividend yield of 3.5% on Procter & Gamble, roughly, which is incredible. They also have a dividend payout ratio of 63%, meaning they pay 63% of their earnings in dividends. So that seems healthy. 5-year growth rate, though, 3%, which is not too attractive, but if we get that 3.5% dividend yield, that's a pretty good current yield. So the growth rate there, it won't be that crazy, especially, or it won't be too big of a determining factor not to invest in it, especially if you have other companies in your portfolio that can make up the lack of dividend growth, which we saw Altria at 10% dividend growth. I have that in other parts of my portfolio. And to get to dividend growth, how many years it has grown its dividend, Procter & Gamble, guess what, guys? 63 years, so it's also a dividend king. So if it gets down to $100, guys, I'm looking to add it to the portfolio and add it aggressively and probably bump it up to my top 10 list. And another one here I'm looking to buy is actually a REIT, and we all know REITs have been crushed, and this is one here that is Realty Income, right? Ticker symbol O. And notice how Altria is very similar to Realty Income, as both of them are really close to their lows, right? Realty Income at about $50. It's not right at its low. It's kind of a little bit above it. Its low is at 38, but still it's very close to its low. And the yield on ticker symbol O right now is about 5.5%. And if you look at historically, guys, when it comes to Realty Income, its dividend yield, when it gets to about 5-6%, that is where value starts to kick in. And there's obviously a lot of pressure right now on the real estate market, as many businesses are shut down. That is no question, and that is the risk when it comes to investing in this REIT. And you guys have to realize there's risks with everything in life. So you guys have to understand that even in the investing world, obviously, there's risk. And their payout ratio is at about 85%. And you guys have to realize REITs, their payout structure, REITs in general have to pay out 95% or 95% of their earnings back to shareholders. So it's not uncommon to see a high payout ratio there. That makes sense. The 5-year growth rate is at about 4.4% with 26 years of dividend growth. And quite honestly, Realty Income, the whole company motto is it's the dividend king. It's the dividend king. Their whole mantra, right? It's monthly dividends. They're touting their dividends. So I don't think they're going to cut it. If they did cut it, that would be very alarming, and I wouldn't actually buy more of this REIT. But I really think it's safe in terms of the dividend. Same with O, and same with Procter Gamble, and same with ticker symbol MO. And when it comes to an ETF here I'm looking to buy, guys, it's going to be SPHD. And many people commented, Stas, SPHD is not so low volatile like it's advertised to be, right? Because it's called the high dividend, low volatility ETF. And let me explain to you why it did see a very big drop. As you guys can see here, SPHD went from 44 down to 25, and now it's back to $30. So another one that's not too far off of its lows, and it could really be offering some decent value here, especially if you're looking long term. And why did it fall? Well, if you look at the sector allocation, it's heavy in real estate and heavy in financials. Well, not heavy, but 2 of the top 5 allocations here out of real estate, utilities, consumer staples, financials, energy, they're financials and real estate, right? And notice, again, all of these REITs, not all of them, but many of them are getting crushed. Realty Income. If we take a look at some of these banks, JP Morgan, crushed, right? Wells Fargo, absolutely crushed. Bank of America, crushed. So as these companies are going down, many other financials are going down, real estate's collapsing. That is why SPHD has gone down immensely, right? And that has brought the dividend yield to over 6%, guys. 6%. And this is also a monthly payer, just like Realty Income. So I want to add more to it. And honestly, I want to bring down my cost because my cost right now is at about $40 from the last time that I checked. Yep, $40 is my average cost. So let's say out of this $500 this upcoming week, I might buy $100 of SPHD. I might buy, let's say, $100 of Altria. And not right now, I'm not going to buy PG, but I might put $100 aside and wait to see if it hits the price target. Then I'll buy some PG. And maybe I'll put $100 into Realty Income this upcoming week. That's kind of what I'm looking to do as of right now. And again, the goal of this portfolio, guys, it's not to keep an eye on it every day, stress about it. It's a passive portfolio. I want to add money into it, and I want to let that money ride, accumulate dividends long-term, reinvest it, and that's just the goal of it at the end of the day. Low stress, just kind of autopilot investing at this point, right? And I do like checking in on it once a week because I'm really into investing, obviously, right? I have a YouTube channel and so forth, over 800 videos on the channel. But, for the average Joe, this could be a very, passive portfolio. And just to look at some other holdings here, again, we're not going to go too deep into it, but I have, Altria, Facebook. There are some companies here that are tech names that don't pay dividends, but I need to have them in this portfolio since they are the pillars of where the world is going over the next 5-10 years, in my opinion, right? I have Facebook, Amazon, PayPal's a fintech company that I believe is the future here. It's going to be a huge player in the future. Down below I have MasterCard, which I want to beef up, the position in MasterCard if the stock goes down. Some bad investments here have been Wells Fargo, Boeing. I bought some Boeing. It's up here. Where is it? Where's Boeing? Ticker symbol BA. Boeing here, I'm down a lot on this position. And these companies, guys, Wells Fargo, Boeing, I'm not looking to add more into them, especially because, financials are hurt. Negative interest rates could be coming. Low interest rates hurt banks, so I don't want to add more money there. And when it comes to, let's say, Boeing, they cut their dividend. And same with Disney. So I'm not adding into companies that have cut their dividend. I'm only focusing on companies now that I believe their dividends are safe, and I believe in a couple of years they'll recover and prosper, right? And those are the companies we talked about earlier, and there's more, again, such as Johnson & Johnson, but I need that price to come down. Microsoft, I need that price to come down a bit. Duke Energy is another one here, but if it gets down to, let's say, the 70, 75 area, I'm looking to add money there. Their dividend could be up to about 5-6% at that point. So these are some of the stocks, ETFs, REITs that I think are safe, the yields are safe, and that I'm looking to buy at this point. And another argument about dividend stocks is, again, guys, the rates at this point are 0 to 0.25%, the Fed funds rate, and they may go negative, right? They may go negative this this fall as the futures market predicted quite recently. So having money in a bank, you're literally going to have to pay the bank, right? To have your money there if you have a savings account. You're not getting anything pretty much unless you're in a high yield savings account like Marcus. There's a lot of them, guys. Off the top of my head, I don't remember, right? So going into some high yielders here could be a good option, especially if you have an outlook of, 3-5 years, compared to some of these banks that don't have a yield. And these bonds, don't even get me started. The bonds are completely crap. So that's pretty much it for this video, guys. Some thoughts there. I'd love to know your thoughts down below in the comments. And leave a like on the video if you guys did find value in it. Subscribe to the channel if you want to keep up with the M1 Finance portfolio. And if you guys actually want to sign up to M1 Finance, great platform. I love it for long-term investing. There's a link down below in the description box. I believe you get $10 once you sign up and fund your account. So enjoy that $10 free. Get it in the market into some of these high yielders. I think they're a pretty decent spot to put some money at this point. But as always, guys, do your own research, do your own due diligence. That's the most important. So I'll catch you all in the next video. Stay safe out there. As always, peace out.